How are credit spreads taxed? Have you ever wondered how the tax system treats credit spreads in options trading? Understanding this can help you make informed decisions about your trading strategy. Credit spreads involve buying and selling options with different strike prices but the same expiration date. When you open a credit spread, you receive a net credit because the option you sell is more expensive than the one you buy. This strategy is popular for managing risk and generating income. For tax purposes, credit spreads are treated as a single position. The Internal Revenue Service views the entire spread as one transaction. This means the tax implications depend on how you close the spread or if it expires. If you decide to close the spread before expiration, you will buy back the short option and sell the long option. The difference between what you initially received and what you pay to close the position results in either a gain or a loss. Typically, this is treated as a short-term capital gain or loss. Now, what happens if the spread expires worthless? In that case, both options expire out of the money, and the entire credit you received is treated as a short-term capital gain. However, if the spread is assigned or exercised, the tax treatment becomes more complex. You will need to consider the strike prices and premiums involved to determine your tax basis. If assignment occurs on the short leg of the spread, and you exercise or close the long leg simultaneously, the tax basis for the underlying stock or options will include the premiums paid and received. The realized gain or loss will reflect the net effect of these transactions. Since options trades, including credit spreads, are generally considered short-term, any gains or losses are taxed at ordinary income tax rates. This can be higher than long-term capital gains rates. To qualify for long-term capital gains treatment, you usually need to hold the underlying stock for a specific period after exercising the option. When it comes to tax strategy considerations, keeping detailed records is essential. Track all premiums received and paid, the dates of your transactions, and the outcomes, whether they are closed, expired, or assigned. You will combine net gains and losses from credit spreads with other short-term trades for tax reporting. If your losses from credit spreads exceed your gains, you can deduct up to $3,000 against your ordinary income each year, with any remaining losses carried forward. Understanding the tax implications can also inform your risk management decisions. Knowing when to adjust or close positions can help optimize your tax outcomes. Credit spreads are taxed as short-term capital gains or losses based on the net premium received versus the cost to close or the outcome at expiration. Assignment or exercise adds complexity to the tax basis calculation but does not change the short-term nature of the gain or loss. By integrating tax considerations into your overall trading strategy, you can align your financial goals with effective risk management practices.